Hey, it's Edna Keep here. Welcome to the Seven Figure Real Estate Podcast. I'm your host. I hope you enjoy this episode. Hello, everyone. This is Edna Keep from Seven Figure Real Estate. And today I have with me one of the students of my program, 90 Days to 5K, but also more importantly, he is a mortgage specialist. And the reason I wanted to bring D'Arcy Henneberry on today to speak with you is because so many people are of the misconception that they need 35% down in order to buy an apartment building. And, I'll tell you right off the bat that a lot of that comes from mortgage brokers who don't know what they're talking about and have never dealt with multifamily. So I wanted to bring D'Arcy on so he could kind of fill you in. He owns his own brokerage, which is really cool. And he's also a big believer in investing in real estate. So with that said, D'Arcy, first of all, tell us a little bit about your background, how you got into mortgages, what you're passionate about, and then we'll get into some more comments about CMHC financing.
Yeah, great. Good morning, Edna. It's really nice to be here today. Thank you so much for welcoming me to be a part of your podcast.
Yeah, you're welcome.
So a little bit about my background. I decided to get into finance back in 2007, right at the perfect time, right before 2008 and 9 occurred. And I started at a bank at the time as a teller and worked my way up into sub-private banking and then decided that I really wanted to focus more on the client rather than just selling products, which was my experience at the bank. I wanted to be more around client-centric and support the client in achieving their goals and helping them win the day. And so that's when I decided to become an independent mortgage broker. My brother and I actually started to develop our company, MortgagePal. And that was, that was back, we started in 2012 and I left the bank in 2013. And so I've been a mortgage broker since then. And I've really had a great time learning about the products and opportunities that we have in the mortgage broker space that are available to clients on the residential side. Over the last couple of years, I've had a desire to move more toward commercial financing, and I've started studying commercial financing, and specific to this conversation, multi-unit residential financing. And it is a bit of there's a lot of similarities, but there's a lot of differences as well. And I think there's a lot of opportunity out there for clients that are trying to get into or Canadians that are trying to get into the real estate market that believe they need to go through the residential route to become, real estate investors. And in speaking to my residential clients, and, some of them are trying to figure out, how do I buy my first residential, condominium? And they're trying to scrape together their down payment or their qualification, their ability to qualify. And, I bring up multi-unit residential financing because there's a lot of different opportunities that exist in the multifamily space that, people that don't necessarily have their own capital, but have a desire to own a number of properties, they might fit really well in the multifamily space and have the ability to build out their portfolio. So it's been a really exciting transition and opportunity to understand both sides and help Canadians really achieve their goals.
Well, exactly. And a lot of people don't even realize. And the reason is because they aren't aware, right? Like, I know people who are buying $1 million condos, and there's no possible way to make those cash flow. So they're feeding them. They're buying them as an investment 100% because they're going to appreciate. And, we've been very fortunate, especially in Ontario and BC area, to have some of those condos really, really appreciate in value. But in talking to one of my partners the other day, we were kind of chit-chatting a little bit back and forth. He decided to rent. He lives in Toronto. He rents a condo, pays $2,000 a month. And he said, people say to him, well, why wouldn't you just buy your own condo? And he goes, because it doesn't make sense. He said, I can buy 3 doors in Memphis, Tennessee, and get $2,000 a month rent and pay $80,000 for those 3 doors, fixed up and everything else. And he said, and in Toronto, I got to pay $1 million a door. It doesn't even make any sense. And then there's condo fees on top of that. So, people need to realize that they have options. And that's why D'Arcy and I are here today, to educate you guys on what those options are. I have people buying $1 million condos, putting 20% down, $200,000. And I have students buying 6 plexes, putting down less than $200,000 and cash flowing $2,500 a month. Like, okay, what's, where are people missing that education? So that's what we're trying to promote, right, D'Arcy?
Absolutely. Yeah. Well, you mentioned the 20% down on the residential side, like you're buying $1 million condo, it's an investment property. The minimum requirement is 20% down. And in some cases, you actually have to put significantly more down just because of, the mortgage qualification process might require that, or the lender might ask for it, even though you One of my new favorite terms is just because you qualify doesn't mean you get approved.
Well, that's true. Yeah. Nowadays, that's absolutely true. There's so many changes. And, so let's compare like $1 million apartment building to $1 million condo. Like we just said, 20% down with a $1 million apartment building. You can get CMHC financing, and D'Arcy, I'll let you kind of go into the nuances of that. We can get it for 15% down. With a residential condo, what, 25-year amortization probably?
Sure. So let's start with residential and then move to just to create a, what am I trying to say? A platform, if you will. So,
okay, sure.
So on the residential side, like we discussed, you need to put minimum 20% down. So if you're buying an investment property, you can't get CMHC financing and put less than 20% down like you can if you're going to move into the property. So on $1 million home, the minimum requirement is $200,000. On the multifamily space, that is different. On the multifamily space, you mentioned 15%. So the minimum requirement is 15% down. And then CMHC will allow you to finance the remainder, and they'll insure that for the lender. Now, on the residential side, you asked about the amortization. You can go to a 30-year amortization on a rental property. On the multifamily side, you can actually get up above 35 years in some cases. It has to be a really newer property. You can go to 40 years. 40, yeah. You can go to 40. So that's on the exception. But generally speaking, you can get 35-year amortizations on a multifamily mortgage with only 15% down. Mm-hmm. It's a different beast altogether. And I'll let you ask another question before I continue.
What I love about it is multifamily is treated like a business. So it's financed like a business. Income has to cover all the expenses. They won't finance you, or at least definitely not at 15% if your income doesn't cover all your expenses, and cash flow still after that. So there's definitely a learning curve to go through to really understand what it takes to buy a multifamily. It's not like you can just run out. Most people pick houses because they've already bought a house or already bought a condo. So it's just one step further to get an investment property, but a lot of times not even thinking it through on what that could mean. And another thing that I like to teach people about is you don't have to buy where you live. Like my buddy Marcy was saying the other day, he lives in Toronto, he rents, but he is buying his rental property in Memphis right now, or other parts of Canada. A lot of my other students are buying in other parts of Canada. So what's the criteria when people are qualifying for a CMHC insured mortgage?
Yeah, it's a good question. Again, I'll show the dichotomy. So on the residential side, what we look at and lenders look at is they look at you first, you being the borrower, the covenant, right? So what's your credit look like? What's your income? Where's your down payment coming from? And then what is the property, and do we like the property? Are we willing to use that property as security to give you the loan that you need in order to purchase that property? So we're really looking at you first, and then we're adjudicating the property. On the multifamily space, it's the opposite. We look at the property first. And as you were just saying, does the property cash flow? It's a business. That property is its own organization.
Mhm.
So we need to think about it as such. We look at the gross rents that the property is generating currently. So the current gross rents, we subtract some vacancy, which generally, even in a market where there might be a very, very low vacancy rate, generally speaking, we factor in about a 5% vacancy rate. And that becomes what we call our effective gross income. And
Mhm.
from there, we reduce expenses that that property is currently incurring. Things like, insurance or management expenses, property taxes, utility costs, things like that, and et cetera. And that then becomes what's called the net operating income. And
Mhm.
that's the number that we use to factor in or to calculate what the actual mortgage balance is available based on that net operating income. In other words, how much of a mortgage can this property support based on that net operating income? So after all expenses, how much of a mortgage can this property support? And so that will be the mortgage amount that will be able to be approved based on what's called a debt coverage ratio. That mortgage will be what's available to be approved for that property. And then that difference between that mortgage balance and the purchase price is your down payment. And of course, as we discussed earlier, our goal is to have that mortgage amount be 85% of the purchase price. It doesn't always work out that way, though.
Yeah. No.
There's something called a lending value versus a purchase price. And so when we ask, what's a property valued at? Well, there's multiple values for the same property. It really depends on how you calculate it. So one value is what we call the market value, which is the purchase price at the end of the day, because you as the buyer are the market. So you're buying it at X purchase price. We've been talking about $1 million. Let's stay with that number. So the $1 million purchase price. Well, based on the mortgage value that property is able to qualify for, and then add 15% of that, add 15% to that, that then becomes the lending value. And the lending value could be drastically different or somewhat different than the purchase price. And you're going to, as a buyer, you're going to have to bridge that gap because the lender and CMHC have deemed that based on their calculation, the lending value might be $900,000. Your purchase price is $1 million. They're going to give you 85% of $900,000. You're going to have to bridge the gap to $1 million.
Yeah, if you want to buy it. Yeah, absolutely, for sure. So those are really, really good things to point out for people. D'Arcy, have you noticed, I know I have, there's been some changes in CMHC rules over the last, COVID hit us with some changes in rules. And then here, maybe 4 weeks ago, there were some other changes. Can you explain and maybe even, give us an idea, what do you think might happen for changes going forward? We think that real estate's just even stronger and stronger of an investment because inflation's going to hit. It's going to be a stronger and stronger because it always keeps up with inflation. And the best place to have your assets or your money is in hard assets when inflation hits. Do you see some changes on the horizon?
I mean, there's always going to be changes. I don't have that crystal ball. I don't know what kind of changes are going to come down the horizon. On the residential space, people might be familiar with this because it's in the news recently. The qualifying rules have changed. And this isn't just CMHC. This is just entirely on the residential space. Yeah. The qualifying rules have changed a little bit. It hasn't made much of a difference, to be honest. Yeah. It's about roughly 5% difference in the ability to qualify. So you qualify for 5% less of a mortgage than you did, a month ago or two. And what personally, I think that change is so small that it's not the end of the changes. It's the beginning. It's CMHC, it's the government really prepping the environment, the Canadian public, that changes are on the horizon. And it's just the first one, I think. And there's going to be other changes. What are those changes going to be? I mean, we can only speculate, and I'm not much of a speculator, but certainly there will be more changes, and really changes are opportunity. I love change. We have an opportunity as human beings to either embrace change or to resist and fear change. I really try to, I fear. So I really just embrace change because it's inevitable, right? So I look forward to more changes. It creates opportunity for all of us, and really just to really understand the changes. You just need to be connected with somebody that can be nimble and understand those changes and work with you to help you navigate those changes.
Yeah.
Pardon me?
Be advised of them quickly too, because
Absolutely.
when you're dealing with the lenders all the time, you're probably one of the first to know. We haven't got a mortgage in Canada for quite a while. So it was just 4 weeks ago that I learned about the last change, which was now when you make an offer, you have to be prepared to send an appraisal, building condition report, and environmental in with before getting your lender sheet back.
Yes.
Yeah.
And depending on the number of units. Yeah.
Yeah. And I'll maybe let you expand on that because I'm not aware of the number of units and all that kind of stuff. And then last year, one of the changes that happened is CMHC used to allow us to refinance up to 85% to pay our investors back.
That's right.
And now they don't. They only allow us, we can only do conventional financing to pay our investors back. We can refi to do renovations and stuff like that, but not. So can you talk a little bit about that?
Yeah, absolutely. So what you're referring to there is when you're buying, actually, this kind of relates to what we were discussing earlier about how somebody that doesn't have a down payment on the residential side, you don't really have much flexibility there unless you can get a gift or something. But when you're buying a rental property, gifts generally aren't allowed, generally speaking. On the multifamily side, we mentioned that you need to put a minimum of 15% down. So where are you going to come up with those funds? As a buyer, you need to have a minimum of 10% down from your own resources. Mm-hmm. Now that can be, me as a first-time multifamily buyer, and I don't really have any down payment or much of a net worth, but I want to get in this space. Well, all I need to do is bring on a joint venture partner that does meet the minimum net worth requirement, which we can discuss in a moment, and also has that minimum of 10% down from their own resources, because together we're now on the deal together, we're on title together, we're part of this together. So it's considered our own resources. So that's the minimum 10% down. Mm-hmm. And that's a joint venture partner that we might invite to be part of the deal for 5 years and have a plan to refinance the property 5 years from now and pay them out. Mm-hmm. Right. And that's really what you teach very well to all of your students. Mm-hmm. The challenge with CMHC recently is that you cannot refinance with CMHC in order to pay out a joint venture partner. That's a critical point. So you can refinance with CMHC, which you can't on the residential ever anymore. That changed back in 2016. On the multifamily space, you are able to refinance with CMHC up to 85% of the property value, so long as over the next 5 years you have the intention of buying another multifamily property. So
just say that again, so I can be clear.
Sure. Absolutely. So basically, if you own a multifamily property, you buy it today, 5 years from now, let's take the joint venture partner out of the equation just for a second. Okay. So, I can buy a multifamily property by myself and I qualify and I buy it today. 5 years from now, my mortgage is up for renewal and my property value has gone up. My mortgage has been paid down by my tenants. I now have a significant amount of equity in my property and I want to use that equity to buy another multifamily property. I can ask and apply for CMHC financing up to 85% of the property value in order to take that equity out and invest that into another multifamily property. That is allowed by CMHC.
Oh, that's interesting. So yeah, because that was something we were always able to do before. So that hasn't changed. So D'Arcy, what would it change if you had a joint venture partner? If the joint venture partner was also moving on with you, that shouldn't change.
If the joint venture partner is moving on with you, it's okay because you're still a team, right? You're still together.
Okay.
Yeah, so that's okay because you're one unit. Think of it as one unit. Whoever is on title is one unit. So if that unit remains constant, and you're pulling out money and together you're going to buy another property and the intention of those funds is to buy another property, you're fine. But if the intention is to split up that unit and the money is being used to pay out one of the partners, that's where the change has occurred, and that's not allowed anymore. So that's where conventional financing comes in. And in that case, you typically can refinance up to 75% of the property value. Again, the property value being the lending value, right? And so you can leverage up to 75% in order to pay out a joint venture partner. It's something very critical that you factor in when you're doing your initial analysis and putting your business plan together, so that you understand those nuances. And when you go conventional, the maximum amortization is 25 years. So that's going to reduce, as you reduce the amortization, it increases your payment, all else being equal. So there's a couple of things that we need to factor in there before you even buy your first property, or and you go into business with this joint venture partner. You need to have that exit strategy planned out in advance, understanding that you're only going to be able to refinance up to 75%, and your amortization is going to be tapped out to 25 years.
So it doesn't always make sense to refinance that in 5 years, but it's all part of the plan, and you have to decide that up front and you figure it out. Best case scenario, worst case scenario, all that kind of stuff. And that's something that I work with the students on to make them understand that. In interest rates, people are always asking, well, I think interest rates are going to go up. Do you have I know you don't have a crystal ball, but you have an opinion on that?
I do, actually. Okay. Yeah, I've got a great crystal ball. Actually, so I should go pick it up. No, interest rates. I guess the question really is, how do interest rates move? Like, what impacts interest rates? And we always talk, especially on the residential side, but we always talk about how, the Bank of Canada or the Fed, they're adjusting interest rates. Well, they adjust their interest rate, like the Bank of Canada adjusts the overnight lending rate, which is currently at 0.25%, but mortgage rates aren't at 0.25%. There's a spread there. So so let me say it this way. So there's two different types of rates. There's variable interest rates and fixed interest rates. The Bank of Canada impacts variable interest rates because as they move their overnight lending rate, then the individual lenders move their prime rate accordingly, and you typically get a discount against prime, and that becomes your variable interest rate. Like prime minus 1% would be 1.45% today, as prime is 2.45. So the Bank of Canada has their rate at 0.25. Most of the financial institutions have their prime rate at 2.45, and then they'll provide you with a discount or a surplus against that rate, and that becomes your variable interest rate. That's how variable rates work. On the fixed side, it is mostly generated based on the bond market. And so as bond yields go up or down, fixed rates follow. And so what we've seen as COVID occurred is we saw bond yields drop significantly, and therefore fixed rates dropped significantly as well. What we're seeing right now, it started at the end of February, is we started to see bond yields go up. And that was at a point where, and this is all from my own personal perspective, but my perspective is that at that point in February, things were looking good COVID-wise, and the market was starting to look good, and there was expectation that we were going to come out of it in the spring and things were going to flourish, right? So bond yields started to go up because there was this expectation of positive economic environment, and then we entered into the third wave. And when that happened, bond yields kind of flattened out. They've been in around plus or minus 0.91%. And last I looked yesterday, they were at roughly 0.9%. So that's on a 5-year Canadian bond yield. And but then yesterday, I think it was the Fed that made an announcement that they were going to make a change to their key lending rate sooner than expected. And right away, you can see a spike upward of the bond yield as soon as that happened. I haven't looked again since about an hour after that. And so I saw the spike. I haven't had a chance to look again. But if that spike continues to go up, then that's going to put pressure on lenders to increase their fixed rates. If that spike comes back down, then that pressure is weakened, if you will. And then if it continues to slide down, we would actually see rates go down. There's other impacts to rates, obviously. There's other costs of lending and things of that nature that individual lenders will adjust. But overall, if you watch the bond market, you can predict fixed rates maybe about a week or two out. You know? Yeah. So yeah. So if you see rates on, like, if you pull up a chart, and it's the Canadian 5-year bond chart, then, and you see rates kind of in that, you know, plus or minus, like just in a very rough, flat kind of perspective, then you can expect that over the next couple of weeks, rates are probably going to stay flat at least. But if you see that spike, and that spike continues without the pressure being released, then you can definitely expect fixed rates to go up in the short term.
But yeah, for the short term, but we really haven't seen much of that. I was listening to a speaker out of the US talking about inflation and talking to different business partners who've said that, you know, Canadian government is only going to be talking about 2% inflation rates because that's all they're willing to give for raises, right? Real estate goes up 5 and 10%. So that's kind of interesting. There's just different ways of looking at the same thing. We've had lots of threats that interest rates are going up, and I'm like, you don't really believe that's going to happen. I think it has to stay low to keep stimulating the economy, and it won't even make sense, and especially for the governments, because they couldn't afford to pay it if it doubles themselves. So I think we're good there. That's my feeling on it anyway.
You know, it'll be interesting to see how time goes. There's definitely multiple minds on both camps, and you know, it'll be what it is. I think personally, if I were to say what my personal thoughts are, you know, just be vulnerable about that. I think that if inflation really takes off, which we are seeing, I mean, you're seeing it in the housing market globally, you're seeing it in food prices, you're seeing it in lumber, you're seeing it everywhere, right? Mm-hmm. If that inflation continues to go up, the banks are going to have to increase their rates, and you know, they're just going to have to, even if they don't want to, in my opinion. And I'm not an economist; I don't really know much more than I've observed, but that's my opinion. So, what would be an unfortunate situation, in my opinion, is if the banks don't increase rates, or sorry, let me say it this way: if the banks take a while to increase rates and inflation starts to really take off, and then they're following inflation and they're trying to catch up to inflation to put a damper on it, well, then they're going to have to increase rates quickly. But if they actually get ahead of inflation, they won't actually get ahead of it. But if inflation is, you know, it's already going pretty quickly and it's already increasing. So if they increase their rates sooner than later, that will be better, in my opinion, for the economy, because they can do it more slowly. Mm-hmm. They can increase rates more incrementally in order to keep a damper on inflation. But if they let inflation go too rampant and then they're trying to catch up, they're going to have to increase rates aggressively in order to put that damper on.
What are the lending rates at right now for commercial? And like, because I'm seeing different, like say a 5-year and a 10-year, because you can also get a lock in a 10-year term, right?
Mm-hmm. Yeah, you'll pay a little bit more for the 10-year.
I think like 2.14. Does that ring a bell with you? Is it somewhere around there for a 10-year?
No, I don't actually know what the 10-year rate is offhand. I'd have to pull it up. Pardon me.
Yeah, I think one of the students the other day showed me, they were asking that, should I take a 5 or should I take a 10? And I think it was just, I think the 5-year was around 1.8 and the 10-year was around 2.14, something like that.
So in my experience, you're going to get those really low 5-year rates if you've got a really large mortgage. Mm-hmm. You need a multi-million-dollar mortgage. I just saw a mortgage of $3.8 million get a rate of 2.14% on a 5-year term.
And that was a multifamily?
No, it wasn't. That was an industrial property.
Yeah, multifamily is different, because one of my students just closed a building, and it wasn't a large building, 1.8. And it was, I think it was her that was telling me she got offered 2.14 for a 10 and 1.8 for a 5.
Well, that's fantastic.
Yeah,
That's absolutely
it's
fantastic.
definitely different than residential again. And we've done 10-year terms before, for our longer term stuff. And again, there's some knowledge that has to go with that to why you make that decision. But it's just interesting to see how that's going to play out over the years. But we're still very pro real estate. We think we're going to have good times. We strongly believe that it's a great inflationary hedge and a good time to be getting into real estate.
Yeah, well, I mean, to answer your question, I'm seeing fixed rates more on the 5-year for multifamily. I'm seeing them more in that 2.3 to 2.6, like I say 2.5 on average, in that range. So if your student was able to get below 2%, I definitely want to have a discussion with her and find out which lender that was, because that is a fantastic interest rate.
Yeah, that was not too long ago. So yeah, you will. I'll point her out to you next call we have.
How long ago was that? Was that before February?
I don't think so. I think that was in April, actually.
Yeah, then that's an absolutely fantastic rate.
Mm-hmm. Yeah, we've seen it.
And that was obviously CMHC insured?
Yes. Yeah. 35-year amortization and stuff like that. So.
Yeah.
Well, we have come to the end. I think we provided our group really good value today, D'Arcy. Thank you so much. It clears up a lot of misconceptions people have about what it takes to get financing on a multifamily. I don't know how many times I've had people approach me and say, "Yeah, I've been told by my realtor to put 35% down on this building," and I always say, "Yeah, well, we can make any building cash flow if you put enough down on it."
That's very true.
Again, thank you so much, D'Arcy, for being on. And any final words of wisdom?
Well, wisdom. Well, one thing that we said we were going to circle back to earlier was just one point about the net worth requirement. I think that's important for people to know.
That is important.
Yeah. The net worth requirement to obtain CMHC financing is that you have 25% down. 25% of the mortgage amount as net worth.
As net worth, yeah.
Yeah, my mind just went to another thing I should mention too. So yeah, you have to have a 25% net worth in order to qualify. That can be yours or your joint venture partner or the combination of the two. Yeah, no problem there. The other thing is, a lot of time when you're doing multifamily, we're talking vendor take back. You're wondering if how do I come up with the down payment, right? So vendor take back is if the seller actually lends a portion of their equity to you during that buying process. Mm-hmm. And so you're actually, the vendor, which is the seller, is taking back a mortgage. So we call it a vendor take back. Now, in those examples, you actually only need to put down a minimum of 10% of your own resources. Mm-hmm. And you can get a vendor take back for 5% or 10% or whatever on top of that. You do need to put a minimum of 10% down, no matter what the situation is or how you're coming up with the down payment from your own resources. And again, that includes any joint venture partners that you have. But then you can get vendor take back mortgages through the seller. You can also get gifted funds from an immediate family member. But again, that minimum down payment from your own resources is 10%.
Mm-hmm. Yeah, that's good. That's a good thing to point out. Okay, well, thank you so much, D'Arcy. And audience, if we have any questions, D'Arcy, how do they connect with you?
Oh, thanks for asking. Well, my email address is D'Arcy, D-A-R-C-Y, at mortgagepal.ca, MORTGAGEP as in Peter, AL.ca. My phone number is 604-992-7323. And my company is called MortgagePal, mortgagepal.ca.
Awesome. Okay. Well, once again, thank you so much, D'Arcy. We'll talk to everyone soon.
It's been an absolute pleasure, Edna. Thank you so much for having me today.
You're welcome.
Thank you so much for listening. It's my sincere intention that you got value from this episode. If you're interested in learning more about building your passive income through real estate, either by investing with us as a joint venture partner or as a student discovering how you can attract investors to your deals and build your own 7-figure real estate portfolio by helping others build their passive income, check out my website, ednakeep.com, or watch my free masterclass at ednakeep.com/90days to 5K.